Welcome back, you legends. I'm Dr. Ken. Let's get right into this quick market update video heading into tomorrow's CPI report. So today was the vengeance of a big cap tech. We can clearly see a theme today. Microsoft, Nvidia, Broadcom, Amazon, Tesla, as well as AMD, Oracle, all leading the market higher today, with the NASDAQ closing up 0.84%. Dow Jones down. Dow Jones was leading the past couple of weeks. It is now down. Russell 2000 basically flat. S&P 500 up about half a percentage point. Closer look at the stock market map. Apple is flat following yesterday's underwhelming event for the company. Otherwise, big cap tech did well today. Cyclicals leading Amazon and Tesla. We have semiconductors leading again, Broadcom, AMD, and Nvidia. Big cap tech in software, that is Microsoft and Oracle, also leading. Big banks lagging today, energy lagging, defensives kind of split, and healthcare doing okay. Let's take a look at the different sectors and see how they rank today. Leading the pack today was real estate, tech, and consumer cyclicals. This is clearly an interest rate trade. All of these sectors tend to benefit from lower rates, and then we have financials and energy, sectors that tend to really dislike low rates. So a clear rate play today across the market. Now let's jump to the daily chart for the S&P 500. This is the RSI, this is the stochastic, and the S&P 500 completed another inside trading day today, closing at 548.8. Strong close for the market today. Even though it is still an inside trading day, we're getting a bit of a bounce off the 16-week moving average. We are now in a range-bound market, very similar structure to what we've seen back here in late July. Tomorrow could give us one of two things, either a breakout like this one or a breakdown or a combination. Which one is more probable? Let's get right into that here on the 1-hour chart. These are the expected moves for tomorrow. 554 on the high end, 543.6 on the low end. This is the expected move, the one standard deviation expected move, $5.2 in either direction for the S&P 500. We did rally off the bottom from that Friday. However, this is not a long or medium term bottom in my opinion. Long-term, medium-term bottoms do not leave unfinished business, such as this very wide gap. So the market will have to come and fill that gap. The question is it going to rally first to the upper expected move on CPI and then come back and fill the gap? Or are we going to get a gap fill and then a rally? My personal preference, I would like to see a double bottom, fill the gap, get this unfinished business done with, dealt with, and then rally. Unfortunately, what I actually think is going to happen, I think the market will rally anyway. And I have a couple of reasons why I believe that's the case. Let's take a look at a bunch of different stocks. This is Tesla. Tesla led the market today. It continues to make higher lows and higher highs, maintaining this ascending channel. Tesla actually led the market today. If I take a look at AMD, AMD closed for the first time in, look at this, couple of weeks, first time above the 5-day moving average. This does now look like a counter trend rally that has more legs. If I take a look at Nvidia, establishes a range, closes above the 5-day moving average today, unlike every other day in the last couple of weeks. So this is significant. Again, something like Microsoft closing today above the 10 and 5-day moving averages. Starbucks, a consumer cyclical, making higher lows and higher highs. Amazon also breaking out today. No guarantees in the market. Nothing is guaranteed in the market. As of right now, full disclosure, I'm sitting on cash. I don't have open positions in terms of trades. I have only my long-term investments in place. Those are still active. I haven't sold those yet. In terms of trades, I'm in cash as of today, and I'm waiting for one of two things. Again, 537 for a bottom and a buy, or 554 rejection and move down. Now, why is this a clear level of resistance and a target? Look at this. Market sells off all the way down to the bottom of the range. Boom, boom, exact same look. Consolidates in the upper half of the range. Again, exact same look. In this case, it actually moved back, completed a double bottom with a bullish divergence. Look at this. Stochastic made a higher low. RSI made a higher low. Then we got the rally all the way to the very extreme end of the range. The market has not completed or dealt with this unfinished business down below the gap from Friday. So actually, in my humble opinion, a rally to 554 will actually be a shorting opportunity and not a positive sign. The stochastic is positive. It is getting closer to overbought conditions. Not quite there yet. RSI just meandering in the middle there. We do have the slow moving average approaching that target. The medium term moving average, we closed right on top of it. And a large counter trend rallies, right? Downtrend, we have one counter trend rally, two counter trend rallies. Large counter trend rallies tend to rally all the way to the long term purple moving average. Tomorrow, that moving average will be sitting at 554. So that is still within reason. That does not invalidate the downward momentum. So realistically speaking, you have two ways of trading this. The first way is to gamble, right? You need to gamble if you open a position today, betting on CPI, either coming in cooler than expected and for the market to like that and react positively, or you're bearish and you're gambling that CPI will be hotter than expected, or maybe the market just will not like it anyway, and you're looking for a sell-off. The second way, and this is the objective way of trading this, simply to wait for the market to reveal its hand for you. Just let the market show you what it wants to do. If it moves down and finds a bottom, that's a tradable bottom for a rally to the upside. If it moves all the way to the expected move and then prints a couple of rejection candles, stochastic completes a bearish cross in overbought conditions, you know it is rejecting and it's moving to the downside. The way I'm choosing to trade this is to simply wait and let the market reveal the direction that it wants to go. Let's take a look at the NASDAQ 100. This is the expected move for today. The market actually, or the NASDAQ, rallied all the way to the upper expected move for today. The upper expected move for tomorrow is 465. Look at this. Prior clear level of resistance, rejected here, again rejected here. So again, even if the NASDAQ rallies all the way to 465, this is still within a bearish downtrending context. Let's take a look at the S&P 500 futures. Had a bit of a pullback today, held at a higher low. It is now consolidating. Stochastic not overbought enough yet, so we could still continue to rally to this prior level of resistance. We realistically have two targets. This prior target, which is around this level. The futures are going to be very useful to look for that rejection once the stochastic enters overbought conditions, to look for that bearish cross down, such as this bearish cross down, such as this bearish cross down, such as this one, right? We see this consistently. Bearish crosses give us sell-offs. Let's take a look at the 2-hour chart for the VIX. The VIX is up top. The S&P 500 is down below. What does the VIX look like? The VIX is oversold. It is at support. This does not, however, exclude the possibility of getting a counter move that is bigger, right? So it does not exclude the possibility of a counter trend move continuing to the upside. However, it is oversold and it is at support, major support. In fact, what happens if it breaks down? Look for the VIX to find support somewhere in here around the 18 mark. At that level, I'd be looking for the VIX to actually put in a bottom as the S&P hits that 554 level and then rejects. Otherwise, if the VIX does not break down, look for the VIX to rally all the way back up to the upper end of the range. In that case, the S&P will have already sold all the way down to 537 and likely has established a tradable bottom. NASDAQ 100 relative to the S&P 500 closed today above the 5-day moving average for the first time in a couple of weeks. That's a positive sign. That's actually synonymous with a lot of counter trend rallies. Here's an example. Counter trend rally takes place as the NASDAQ relative to the S&P closes above the 5-day moving average. Again, happens again during this counter rally out of the exact same kind of range that we are trading inside of right now. We are somewhere in here, relatively speaking. This is where we are in here, and the market is setting up for one additional move to the upside if CPI is viewed positively. Once that is done, look for a rejection at 554. Prior level of support will now act as resistance, and that will likely reject and move us to the downside. The stochastic is not oversold enough yet. RSI not oversold enough yet to look for that longer term kind of multi-week bottom. So I'm not seeing a multi-week bottom out of this bearish engulfing candle. Best case scenario, this is just a counter rally with some additional marginal upside left, and then we continue lower. Tomorrow, CPI expected to hit 2.6%. The consensus for headline CPI is 2.6%, and for core CPI to be flat at 3.2%. If CPI misses on either of these, comes in higher than expected, in either of these cases, look for a sell-off. If it comes out better than expected, lower than expected for either one of these, then look for that rally to 554 for the S&P 500. For the NASDAQ, that level is around 465, this prior level of resistance. So very quick summary here. We're still in bearish context. We're still in a downtrend. Counter rally either has 1 day left, that is tomorrow, or it is actually over. As of right now, I'm leaning toward a rally to 554 tomorrow. This prior level of resistance rejects and then moves back down to the low end of the range, 537.5 for the S&P 500. Unfortunately, in my view, if we rally to the upper edge of the range first and then move down, that'll be way more bearish than if the opposite happened, where we moved down, completed the gap fill, completed this unfinished business, dealt with it, and then we rallied to the upside. Here is seasonality. We tend to have a negative September, negative October in election years, regardless of whether it is an open field or just a run-of-the-mill election year. Typically, we get a counter trend rally toward the latter third of September. That is around the 20th of September. I still think that's the case as long as we actually fill this gap below this week. If we don't, that actually sets us up for a negative bearish week next week. With that being said, next week we do have the Fed interest rate decision on September the 18th. And a lot is riding on this rate cut. The market is now pricing in a 50 basis point rate cut. That is 0.5% rate cut. That is more than what the Fed actually signaled. So if the Fed comes out and actually cuts by 25 basis points, will that be viewed as negative? Will the market react negatively toward that? Again, if we leave this gap unfilled below, it just increases the odds of a negative reaction next week. Fear and greed improved slightly. We went up to 40 today. Market momentum improved slightly. Stock price strength is flattening. Breadth is still declining. Put to call ratio still rising. Market volatility, however, did come down. And if CPI is within expectations tomorrow, expect the VIX to get crushed. A low VIX, low volatility is positive for the overall markets. So one of the key hints to look for tomorrow at 8:30 a.m. Eastern time is for the VIX to actually break below this prior level of support. If it does, that'll give the markets the green light to continue this counter trend rally. That's all I have for you today, legends. I'll catch you in the next one. Have a good one. Bye-bye.
Oh, wow.